Hello everybody, welcome back to my channel, and today I'm here with Curtis. Hello Curtis.
Hi, Dave.
And we didn't do together the presentation that I aired a month ago, so we are fixing that at the moment with an update. So I have updated for you the bullish and bearish arguments. I'm gonna go through them. Curtis is going to challenge me, react on that. Guys, how I have done this update is through a simplified way, what I believe it is simplified way. So it is all the bearish arguments on one big board connected with the bear meme. When you see these connecting lines, these connecting arrows, guys, they have different width, okay? And the fatter the line, then the stronger the argument, the way I see it. So all these very thin lines, I believe these are very weak bear arguments. But some of these fat ones, some of them I believe are fairly good, very strong. So the first argument is actually not even entirely bearish. The line is very thin, so it's kind of like, you know, at zero. This is the M2, the global M2 and the Bitcoin correlation. So basically this chart, these candles, as you can see, these candles, those candles is basically Bitcoin, okay? These candles. And this yellow line, that's the global M2, and it's overlaid one over each other. It's showing how strongly it was correlating over the past year or so. However, recently, ever since, let's say, July, ever since this moment, I would even say, actually there is some discorrelation as well, because the M2 was actually going still up, and Bitcoin actually started correcting in August. Also, very important is how you skew it. Okay, so because this is not one-to-one, the timing is different. As you can see, M2 is like going, you know, it's like further ahead, and the Bitcoin is just here, which means that I have actually skewed it in time. So I have made the global M2 like go forward in time. By 78 days, the value is here, is written here. Some people skew it by 30 days, some don't skew it at all. But this is the way how it was fitting the most in the past. That's why I picked 78 days. Global M2 went into new all-time highs recently. That is actually bullish, meaning that Bitcoin should also, technically based on this, go into the new all-time highs in the Q4. But I have it in the bearish arguments because this was showing as well in the from mid-September all the way to like the start, like the first week of October, a correction, okay? And we're actually in that window. So that's the long story, basically.
But yeah, I think M2, remember, it's not just crypto, right? M2 affects the stock market, and we're getting a ton of really big moves in stocks. Like Mag 7 is getting a lot of investment. So we just hit 6,700 on the S&P. So some of the M2 is getting absorbed into stocks, and that may be why you're seeing a bit of a disparity here.
Okay, so next argument, oops, and again, a very weak argument, I believe, but I just wanted to bring up one on-chain, the Puel multiple that used to be popular the last cycle a few years ago. Now people don't look at it anymore and that much, but that one, when you draw the trend line, basically, it basically peaked, it touched the trend line, and that was actually in March 2024, right here. So like based on this, like kind of like a cycle peak. But the on-chain metrics like this, like the last cycle, we have had many more than we have today, meaning people paid attention or believed in them much more. But then so many didn't trigger in 2021, and especially not in November. So nobody sold, everybody got obliterated. So today people don't pay attention to them anymore. So this is a very weak argument still. Another weak argument, or actually very short-term argument, we could say, is the sentiment. Although again, I'm not even sure if I should interpret this as the bearish now. The thing is that we are in fear in both greed indexes, okay? Both of them are, which is actually bullish. However, my point is that, for instance, this sentiment index is the CMC index. We've made this cluster in the fear. You see, Curtis, like we stayed in the fear for actually like several weeks to a few months period. The same here in the Q1 this year. The same here in basically June, July, August last year. But we have not yet made that cluster. So basically what I'm interpreting here that we should stay longer in the fear before we can say that the sentiment is really fearful and bottoming out, and now we, based on that, we could go back in the market, those of us who have cash.
I'm surprised it's so low. It doesn't seem like the market's in fear. That
Oh,
seems,
yeah.
I would say if we're below 100, I would be very worried.
So maybe that's where we'll bottom.
Could be,
I mean, I
yeah.
don't want to cause you stress, but that's, I think many other people feel the same like you, Curtis. And I think the market really tries to just, make people really worried before
Sure.
it rallies
Yeah.
again, right?
Yeah, below 100, I think would worry a lot of people. But I don't think we're going to go down.
Now, another argument, again, weak argument, very weak line. People look out for many different golden crosses and death crosses. So what is a golden cross? What is a death cross? It's basically when certain moving averages cross certain way. Many people watch different moving averages. What I have good experience with is when these two lines, I have it as pink line and a yellow line, and those are basically 20 weekly SMA and EMA. And when they cross, that the pink goes above the yellow, that's what I see as a death cross. And I've been tracking this for about a year or so, and pretty good results. Right now, we had the death cross. Even though this was very beautiful how we actually bounced from there at the very same moment we made the death cross. I don't think this ever happened, that we bounced from exactly the intersection from above it. But after we've made death cross, the last time it happened in February 2025, instantly after that we went down a lot. Well, quite a lot. That was a strong correction, even for Bitcoin, and Bitcoin held the best. Then the death cross we had in May. And remember the last year in May 2024, we were retesting the all-time highs as they were back then. After we made a death cross, we again, went down. And then on this chart over the past 2 years, I don't see the death cross anywhere. It's actually the 30.
What is the yellow? What is the moving average? What's the number?
So it's a 20 week, and one of them is SMA and one of them is EMA. So the yellow is EMA, 20 week. Okay, and basically they form the famous bull market support band. But again, very few people are now looking out for the bull market support band because the Bitcoin is not following it as well as it used to in the past. So basically what this means is death cross, that basically this should be a failed rally. I took this sample, this was 116,000. I took this sample like on 16th of September. So I took this sample a week ago. So right now we are already kind of failing and we are back here, but we are still holding these lines. We're still holding these lines. So let's see what happens. But the death cross says we should go below them. Now, a stronger argument, the fatter line. Where is liquidity? Okay, I've seen again people saying that biggest liquidation ever, what happened, and which is not the case. And I have the next data about it. So where is the liquidity? Where, like, are people longing more or are people shorting more? So as you can see from this heat map, there is quite a bit of shorts, that's true, which will probably be taken at some point. But what is there really a lot is the longs, and those longs in this area. And this is the area between 103,000 and 107,000. That's where the most liquidity is, and that's why I have it as a bearish argument. And I think that this should be taken. Then there is not even that much liquidity all the way. There is some, based on this heat map at least, there is some about 93,000 or so. But really, the liquidity to be taken next is between 103 and 107. Next argument, there is a very far line, because I think this is a strong argument. And this is about liquidations. And it's connected to the previous data. So I know there is actually two data connected. So I know that people don't really understand when I show this chart, but it says it right here what it is. It is open interest slash market cap, and it's a ratio basically. It's one divided by the other, and there is a ratio that you get What this actually means that the higher the ratio, the more open interest comparing to the market cap there is. And the higher this number, then basically the more over leveraged the market is. Look at 2023. Do you remember the August correction in 2023? It was a beautiful correction because I was basically all in cash there or so. And look at this, how this ratio went down. Look at that, and this is exactly it. Something like this always then happens, and then the ratio goes down. People get liquidated, and the ratio goes down. The same here. This was in August here, in August 2024. You remember the Nikkei crash? Of course you do. And again, and we have, and also recently, actually, yes, of course, the February this year, of course, in Q1. The ratio is high. That is my point. The ratio is high. And I believe it's mostly longs, also as we've seen the previous data. And one more data that I have here is the BTC total liquidation chart. I see lots of misleading information on X saying that we had the biggest liquidation in the history, which is definitely not true, even though altcoins have had liquidations, but Bitcoin didn't. As you can see, like this candle, like this line, the bigger the green line, the more longs were liquidated. Okay, there was actually lots of shorts liquidated here in the summer. Actually, people have been very bearish going into the summer, very bearish, and that actually also proves to be some kind of a top for now, at least, right?
Right.
So we are waiting for a big green candle like that or so on the long side, basically. Another chart, this is it's rather a very short-term argument. I have been watching Siovaco Capital. They have a channel, and they've recently also made a video about basically we are due to correction, like on average, like S&P 500 after RSI is about 45 for 100 consecutive days, which is at the moment the case. And with every single time we had, like within the next weeks, we had some kind of a correction. They've calculated that average is 2%, which is very little though.
Yeah,
But
small.
very small. But I just wanted to show that they are basically bullish. They're very bullish, but they're also saying that some correction is just due at the moment. Okay, so now I think the fattest line that I've put there, this is the conclusion for my presentation. I have aired it at the end of August. And in that conclusion, I gave you that what I see is basically two possible scenarios, and scenario A already didn't play out. So I have it crossed. So now scenario B, basically. Scenario B says that, or the way I saw it a month ago, that S&P continues setting new heights into the September FOMC meeting, which is like mid-September, which is happening. Basically, S&P is pushing new all-time highs still, even this Monday, with crypto also staying strong, which also happened because it stays strong still. In the second half of September, however, a correction of up to 10% begins of S&P 500. So basically 5 to 10% or up to 10%. Under this path, crypto would be near a start of its consolidation. And again, I aired this at the end of August. So basically we made a top there. In the mid-August, we made 4.17 trillion top. And a sentiment reset, which is happening because we've just seen that the sentiment went to fear, at least briefly, even though we didn't stay there for now. And the total index crypto potentially dropping 20 to 30% over few months. I wrote several months, but could be few months. So, and this is the conclusion basically that I have based on lots of data that I was reviewing at that time during that presentation. So it's like lots of stuff combined into this. And this is from a month ago, and it could be that the scenario B is playing out. Another argument, a weaker one. Yes, this is the imminent threat. I talked to Curtis about this as well. So we have the funding lapse and the possibility of the government shutdown for most of October, starting at the 1st of October. Polymarket estimates that as a 64% chance. I know 400,000 volume is not that much, but there is another poll which is bigger and also estimates a high chance, even likely that it's going to happen. Yeah, I think this is going to be the decisive factor. I think if this clears up, if this is not going to happen, if this is just a political scare, which most of the times these things are just a political scare. People say, quote unquote, nothing ever happens. I'm sure you've heard that sentence. Most of the time, this is just a scare. And then it's just like they're just pretending they don't have a solution. And then a few hours to the deadline, bop, just solution is there, deal is made, and this thing is cleared up. That's how it's usually played. Will it be this time as well? We shall see very soon, very, very soon. 5-6 days or so. So if this is just a scare and if it's not gonna happen, then you should bet on Polymarket for no, because you're gonna triple your money in 1 week time if you now bet no on this, and if it's really gonna be no in a week.
Even if the deadline is breached, okay, so you would win the bet, or you'd win the bet if you said it was going to happen. That doesn't mean asset prices are going down, right? So yeah, so the Polymarket bet is simply, will there be more than 1 hour of delay or 1 day of delay, right? That doesn't mean markets are going to respond negatively, because the government has never not paid its bills in its entire history. So the market likely discounts this quickly, and almost it may just discount it completely. But you could still win the bet that there was a shutdown or a delay, right? Do you get my point there? So there's sort of two different issues there.
I get your point. What I think that is going to happen price-wise, if the United Government shutdown happens, it would probably be a shutdown for a few weeks actually, or at least like 10 days. I think it's not gonna be 1 day. Do you think it would be just
I don't think so. I don't agree, but yeah, let's see what happens.
Oh yeah, we'll see what happens.
So in 2018, there was a 35-day shutdown.
Okay.
And then in January of that year, there was a 3-day shutdown. The last time there was a major shutdown was 2018.
Yeah.
But before that, it was 2013 and then 1995. So there's not much precedence to have a long shutdown, just to let you know, but it's possible.
Yeah. And the last one was with the Trump again. Trump was
typically there. But also, you're not seeing the market anticipate this. So the market knows what you know. And so and we're at all-time highs. So I would say the market probably knows better than you and I. That doesn't mean surprises can't happen. Often for example, they'll have a deadline, Dave, at like 12 p.m. midnight, and the voting will go until 1:30 a.m. And that would technically be a shutdown or some sort of missing of the deadline. But by the next morning, it's already resolved, or the next day, and the markets sleep through it or just don't do anything about it. Yeah, just giving you some context there.
Yes, if this would happen, that would be definitely very positive for October, actually. And that would be probably very strong price-wise, the October. Two more arguments. One is the Buffett indicator. I'm sure you're familiar with this. Wilshire 5000 to GDP is actually in the new all-time highs. Just wanted to bring this up there.
Well, maybe you want to explain that to your listeners, what it means?
It's a ratio of the Wilshire 5000 index divided by the world GDP.
Right. So it's saying that things are very expensive according to this indicator. And then PE ratios are very high too, The S&P 500, let's say, just looking at the S&P 500, the companies have gotten a lot stronger than they were historically, and they're a lot more profitable. And the reason they're more profitable is because the S&P is now made up of a lot of tech companies. And tech companies have much higher margins and profit margins than what was in the S&P 500, let's say in 1980 or 1990, right? So because tech is dominant, the Mag 7, etc., but that their profit margins are much higher than, let's say, a tobacco company or an oil company. So that's why we're seeing much higher PEs, and that the value investors that focused on PEs have been very wrong for many years now.
They have, or less at all.
It's relevant, but let's just say there's reasons why it's less important.
The last argument, that's the strongest bearish argument that I have, the fattest line, is that the jobs report have not been, let's say, not very good, or doesn't really sound that good. Do you agree, Curtis? Like we had the past few months, June minus 13,000 jobs, August 22,000, July 79,000. And this is definitely not, when you look at the previous months, when you look at this chart, it's basically downtrend.
Right. And they revised the last 12 months and they took 1 million jobs off. I don't know if you
They
saw that.
revised, yes, they revised them,
So,
and yeah.
so, so yeah, I would say this is the biggest risk. You were saying the shutdown, but I would say the next two job reports for
Okay,
September and October are probably would be my biggest concerns. The
okay.
concern there is that we actually have job losses, right?
Mm-hmm.
And that becomes some sort of headline that legacy media picks up and starts screaming recession again. Um, I don't think that's a risk. Like even if we get weak job growth, I still think corporate profits can stay strong for various reasons. But the market might disagree with me and get scared, and they might give you your maybe 7% crash. Just a little bit. If you're talking about a 10% crash, that would take us from 6,700 down to like 58.5.
Mm-hmm. Or
That's
6,000.
like that. But I think 5% is reasonable between now and the end of the year. And I think a 5% drop would be something on a job scare. And that would be maybe October or early November. It would be headlines saying that job losses are here. And it scares people. I think some of the job weakness is priced in. Jerome Powell talked about it. Anyways, this is the number one focus I would have is as a bear headline would be jobs weak for the next 2 months.
And with the report coming 8:30 a.m. Eastern Time on October the 3rd, it's basically the same week where we will see the resolution of this potential shutdown as well. So basically,
Right.
the first 3 days of October, those are going to be volatile. So do you see these white lines, Curtis?
Right. That's the barometer. Yeah.
These white lines are the barometer. Yes. This was the most accurate barometer probably ever. It is not supposed to be so accurate, but it was so far this year. So unbelievable. And it's showing that basically like it should peak right now for a whole year, S&P 500, but it should still remain strong until, and this is the first 3 days of October. Do you see this drop here in this
Yeah.
it's
Yeah.
between the 1st of October and the 3rd of October. That's just so
Yeah.
interesting. That's where we're gonna get the job report and the government shutdown resolution.
I don't think it's going to happen, but that's interesting.